Hello everyone. On behalf of AKC Capital, this is another series where we wanted to cover important aspects on the financial markets and behavioral finance. And it gives me immense pleasure to have with me Mr. Ajit Menon, Chief Executive Officer of PGIM India Mutual Fund, to share his views and perspectives. So over to Ajit. I think, thanks Ajit for your time for this meeting. And over the next half an hour, 40 minutes, we'd like to have some questions and looking forward to
Sure. It's my pleasure to be here, Aditya. Thanks so much.
So my first question, Ajit, is that for Indians, markets have always been about the levels of the Sensex, Nifty. Is it always and only about the market levels that one has to be concerned about creating wealth? Or is there something more to it other than the timing of the markets?
Well, I think that's two very important questions. One about creating wealth, and the second about the market itself and the aspect of timing the market, as you mentioned. And to me, I think, Aditya, that when we talk about wealth, it's a very personal definition for a lot of people. To give you an unconventional angle to this, if I ask my father about his concept of wealth, it has always been, it still is, that his health is his biggest priority and health is wealth.
Yes.
Like his mother would have told him and he's told me, and I completely agree to that. But when we are talking about the conventional aspect of wealth, my sense is that there is a tendency to obviously focus on one aspect that can get you there and get you quickly, which is why the aspect of timing comes in. Whereas, my sense is that wealth creation is a whole lot more than just about the markets or aspects like timing. It is obviously, India, given that it's a young country and it has its aspirations, this is what comes front and center in most discussions. But a holistic approach to wealth has to start with aspects including, as I said, your health. Because if you think about it, what's the point if you had 50 crores in the bank but you were lying in a hospital bed? Right? So I think that not talking of bad outcomes or negatives related to health, and we're talking about wealth, it is definitely more about being holistic around all of what can help you reach the goals that you wish. Because one can say wealth, it doesn't mean anything without a time frame attached to it. For most people, maybe it will be about, when we talk about timing and include the aspect of timing, indirectly what we are saying is, I want to be wealthy and quickly. So as many wise men would have said, it's about getting rich slowly. And in that, then you need to consider not just one asset class that you can invest in, but think about the entire domain of assets that you can access and invest in, which includes equity, fixed income, precious metals like gold or currency, real estate, as we know, and even alternates. So I think it is to be holistic. And timing, well, I do think that most experts would have said that, it is more time in the market than timing, and most people would have heard it. But I think it's more about thinking that as a human being, it's simply impossible to time. And so what's probably the bottom line to this question is that it has to be a process that you either define for yourself or you define along with an expert whom you can trust and help you define that process. I think that's where it should be.
Great. I think very insightful. And let me kind of summarize the key points that the way you answered the question. I think the first takeaway for our viewers is that, is the health part itself. Because you got to be healthy.
To enjoy your wealth.
I think that's a very different perspective. I think the other point which you clearly outline is, have a view across asset classes. So, be it equity, fixed income, alternate assets, and probably, if I may add, there are very emerging asset classes like crypto assets.
Absolutely.
Over time. Obviously, one needs to understand the risk and rewards attached, and the tax, the regulatory repercussions, all that stuff. But I think the second point which clearly came out from your perspective is to have a view on all asset classes, to have a more holistic approach. I think the third point, just to summarize for our viewers here, is to really have the process element.
Absolutely.
Because if you're out going to there to create wealth, I must have a process to it. And if I may add to your words, I think process is all about quantifying your goals. It's about a disciplined approach to investing. And that would be, I think, the key constituents of process part as well. Yeah, and I guess, like you said, it's not about timing the markets. It's about just being well aware that everything in life takes time. So if you have the other three components taken care of, then I think you're part of it.
It is. And just to emphasize, the reason I talk about process is because the science of wealth creation and investing as we know it today basically says that the biggest enemy that you will face in that journey of creating wealth is yourself. Your own behavioral biases, your own emotions, especially when it comes to money. And that's why I highlighted that the process is something that helps you override those unforeseen errors that you might end up making.
Thank you so much. Which brings us to the second part of a question. PGIM today is undoubtedly one of the largest money managers in the world. Could you throw some light on the group and, more importantly, your values or the value statements, if I were to articulate it? Also, what are, for all our audience and viewers here, what are the PGIM plans for the India market as we go forward?
Sure, Aditya. PGIM is Prudential Global Investment Managers, part of Prudential Inc. of the US. It's a 145-year-old entity, and is now a little over $1.4 trillion in size and the 11th largest asset manager in the world. The mothership Prudential is insurance and very, very large in the US and some other markets. And PGIM is the asset management arm. And Prudential and PGIM, it's a multi-manager model where you have housed the expertise of equity in one place, which is the PGIM Jennison. You have fixed income, you have real estate, you have private credit, and private equity. So, the expertise is definitely in each of these buckets. It's not one single entity that allows culture and the freedom to build on the solutions for customers as we see it. So you have your best expertise working on it rather than a sort of a common thread running through all. The common thread that runs through all, however, as you mentioned, is really the purpose statement for Prudential, which is that we make lives better by solving the financial challenges of our changing world. And I think that it is a very beautiful and apt purpose statement for an asset manager. The ultimate goal being that we have to make lives better. But how do we do it as an entity, given where our expertise is by solving the financial challenges and recognizing that it's happening in a changing world. So that's the purpose statement, and it has been a guiding force for all of us across the group and for us here in India. Much of what we intend to do in India, we have been doing in India, has been around this purpose statement. We are probably one of the only asset managers to have dived into researching around retirement readiness for Indians with Nielsen. Our value adds to our partners have been around retirement and financial wellness. But most important is that we are a platform for performance. And, we have to have that pursuit for outperformance, which is the kind of campaign that, PGIM has world over. And I think for us, that comes from an adherence to process, a very, very clear process, which is centered around being an active manager. It is not that we don't have passive solutions as well, but we believe that for an asset manager, the rise on the thread has to be that you have to actively manage the money that you get from your clients. And how to do that is to continuously look at your process and let the process be the winner. As I was mentioning earlier, if individual investors have their worst enemy to be themselves and the behavioral biases, we have to remember that managers are human beings themselves and are prone to behavioral biases. So we have designed our investment processes and policies in such a way
Right.
that we are not just looking at assessing the macro market risks or assessing the sectoral stock risks. Of course, we do that very diligently, but we also look at opportunities to put into our process ways and means where we can think about behavioral risk.
Absolutely.
So that managers don't fall in love with their stocks or those kind of
Correct,
things
right.
that can happen. So very proud to say that process has been working very, very well for us. While we have a great team, it is the process really which is the hero.
Right.
And as evidence to the process, for instance, a key part of our process is to bring companies into our universe which have very consistent positive operating cash flows for
Right.
at least 7 years out of 10 or 70% of their reported financials.
Right.
How that has helped us, for instance, last year is that we did not invest into a single IPO that came in the market.
Yeah.
In that sense, we would have protected the money that investors had given us, given where many of those IPOs are
Yeah.
today.
Yeah.
And we invested in none of them. We had
Correct.
2 which
Yeah.
were non, e-com necessarily related or tech related, and we made money in both of those.
Right,
Because, you have to define that your biggest role is really downside protection.
Right.
And I think we've built that into our process. We'll continue to do that. And our plans for India is to build out on the platform. We have a mutual fund license. We have a
Yep.
PMS license.
Right,
We
right.
also have an AIF license, which we haven't activated, which we will do.
Sure.
And I think eventually as we get further in our journey, participate in other parts of the market like pension and other alternates that we can. So for now, we are committed to the task of continuing what we are doing well. And then as the opportune time comes up, we will expand the capabilities and offerings for our clients.
No, I think well said, and thanks for your inputs on this. I think clearly, the process part is coming out very, very clearly in all the strategies, and obviously the India market focus is crystal clear, given the fact that you have the mutual fund license and PMS and AIF is also
As well.
there in place. So I think big plans for the India market, and
Of course.
good to know that.
Sure.
I think which brings us to the next part of a question is that if you see over the last one quarter and more, inflation and interest rates have been at the front and center of all discussion points amongst investment pundits. While these are important factors to monitor, obviously, how important a role does asset allocation play in the middle of all this noise?
Well, it has to be seen in the context of each individual investor. And that's
Right.
where asset allocation starts becoming not just theory, but something to practice very diligently.
Okay.
We call it personal finance. We
Right.
call it personal finance because it is personal. And one issue with media, for instance, is
Yeah.
not that they're doing anything wrong, but they can't help but be general in what they are saying and what they are recommending
Right,
to
right.
all their viewers.
Right.
But when you think about your household and my household, I have kids who are getting ready to go abroad for future studies.
Yeah, yeah.
I have, my parents, thankfully, touch wood, they don't have health
Right.
challenges, but others could. Or there could be other challenges that people are facing in their
Right,
household.
right.
So it's very personal. That's where, sitting down with a professional who can help you with what can work for you in your unique personal context
Right.
is so important. And that's where asset allocation plays such a role.
Yes.
Touching on inflation, yes, it is an important factor for all of us to consider because inflation is obviously related to actions, therefore, that governments and central banks take to control it, which means a change in interest rates. And the domino effect of that is interest rates then go on and affect every other investment that we hold, whether it's the discounting we do for future profits in equity or the yield we get on fixed income and so on and so forth. So it's very important
Right.
to keep a track of that. However, I think for our Indian viewers, one aspect which I think is less appreciated is that the Indian central bank actually changed its policy in 2014-15 when Raghuram Rajan was the head of the central bank. And what they do now is to focus solely on inflation control.
Yeah.
Usually, central banks will have a dual mandate of inflation control and stimulating growth.
Yeah.
The Fed in the US, for instance, have 3 mandates.
Right.
They inflation control, stimulating growth, and stimulating employment. In India's case, what we have done is, while we will support growth as a central bank, I think the central bank is solely focused on making sure, or the biggest mandate for them is controlling inflation.
Right.
Not just that. The other change that happened during that time is for the central bank to say that it is not WPI that we will now focus on, which we as a country have been focusing on for 70 years probably, till it changed. It is going to be the CPI that affects people on the road. And they went one more step ahead, and we are one of few countries in the world where we have an inflation target of 4% plus minus 2, as most of you would know. Now, my message to our audiences or our investors is that it gives me personally a lot of confidence to have a central bank today, as compared to the last many years and decades in India, focused around controlling CPI inflation to a target number and taking action when it is required. What that does is actually it should give us a lot more confidence around the investment decisions that we are making, a lot more predictability around what we think we can do with it. So I think it's an important factor to consider.
Right. No, I think well said. I think the key points, as you'd see, that is the point that you've clearly made out, is the changing role of the central bank in the last since last 5-6 years. So clearly inflation management, and in a way indirectly trying to support growth as well. I think my personal take is that the Indian Central Bank, as we see it today, has been playing a very active role in terms of managing the currency as well.
That's true.
Kind of, currency is under pressure, as we know right now, but they've been selling dollars. So I think it's an active central bank. That's a key takeaway, which is good for the overall economy. And I think the other point which you clearly mentioned, and also for the viewers here as well, I think market factors, inflation, interest rates are always there to say. Obviously, it's important to be cognizant of these factors and maybe respond to changes in your portfolio through the right asset allocation.
True.
Because end of the day, I think the right asset allocation would ensure that you have better risk-adjusted returns in the portfolio.
Absolutely.
As well.
Absolutely.
So I think these market events, inflation, and the reasons, interest rate, monetary policy, these are part and parcel of life. I think the key part is to really respond to these in a calibrated manner, not to panic around. And I think asset allocation, end of the day, seems to be one of the elements that would help us.
I completely agree. And like you said, while we have an active central bank, let me also add we have a very independent central bank today, because under Urjit Patel, the MPC was formed, where it's not just one individual taking a call on the interest rates. It is a panel of people with 7 independent members giving their decision to it. So that independence of a central bank for a country is also institutionalizing the central bank further for our benefit. And all of those factors you mentioned about, they are all inputs into that decision of asset allocation that we take based on, it can't be the main factors, they're input factors, and the asset allocation then becomes the hero based on your time frame again and your goals, I think.
That's well said. Which brings us to our next question. The importance of behavioral finance is highly underrated in the journey of wealth creation. I think that's a very, the question I want to bring forth to you. Could you share some of your experience of how important an aspect is this for clients to know?
I think that most of us are quite self-aware, and we know that we have some of these biases, but they sometimes lurk under the surface, and we are prone to them without realizing that we are getting into a trap ourselves. And it's not unique to anybody here in India. It's unique. It's for every human being, so to speak. And I think the importance of behavioral finance, when we are thinking about wealth creation and managing money, is to think about the fact that the science, as we know it, assumed one very important thing for the last 50 years before the behavioral finance aspect started becoming more important. And that factor for the last 50 years is something that still drives a lot of thinking. And that aspect is that man is rational. and we take rational decisions.
Yeah.
So you can put all of this in an Excel sheet
Yeah.
and figure out correlations and portfolio optimizations that work for you.
Right.
The science has moved forward with Daniel Kahneman and Amos Tversky and then Richard Thaler to say that man is not rational. They don't take rational decisions. They tend to take emotional decisions. And really the job is thinking about your financial habits or the habits that you have, not just for finance, other areas. Because it is habits that will take you to where you are. In fact, there is a very favorite quote of mine by a gentleman named by F.M. Alexander, who said that people don't make their futures, they make their habits, and their habits make their futures. I could turn that around to say people don't make their financial futures, they make their financial habits, and their financial habits will make their financial futures. So behavior, science, whether it is Daniel Kahneman or Richard Thaler, and that science is progressing even further, is something for us to then leverage and take advantage of. We tend to get very overconfident. We tend to get, if it's a great situation that we are in, we tend to take over-optimistic decisions.
Right.
If it's a very depressing situation that we have been through over the last week or day, we tend to take ultra-conservative decisions, and both would be wrong.
Yeah.
People are optimistic. I will win the lottery, but she will get cancer. You don't think that you will get anything bad. We don't catastrophize like that for ourselves.
Yeah.
So we tend to be over-optimistic. So whether it's our own ego and overconfidence, given that small pieces of information make us feel like we have a lot of knowledge about what we should do. Emotionally, we could get swung. Whether we are happy or sad in taking different kinds of financial decisions. The kind of information, attention that we give to can tend to throw us off track in how we allocate our resources in the near term.
Yes.
So all of these are ultimately behavioral challenges that we face. And the solution probably, therefore, as I mentioned earlier, lies in coming to a conclusion on the process that works for you, where you put up guardrails so that you don't trip up on it. Just reducing the probability of failure, reducing the probability of losses should be your goal. You're not going to eliminate it.
Right.
And you're not going to hit the lottery.
Correct.
It's all chance.
Fair enough.
So a more predictable way is have a process that has the guardrails that work for you.
Right. I think very valuable inputs here. I think if I have to just bring one or two important aspects you mentioned, and just to kind of summarize for our viewers as well, is that I think financial decision making, should be devoid of emotions wherever possible. You cannot eliminate emotions completely, I would say. But to a large extent, you should avoid the emotional aspect.
It is.
And take it more logical, that's in the longer run, right? It's a more practical way, if I were to articulate it.
Absolutely. And all of what I've read of behavioral finance, Aditya, it sometimes seems to me that it's also very esoteric when you talk about it.
Yeah.
It seems very logical and nice and commonsensical, but it's sometimes esoteric in the sense that, so what should I actually do?
Yeah.
To me, in my mind personally, I think that the question that you need to ask yourself is, are you being too concentrated in the strategy that you are attempting to do? Even if you ask that one simple question, I think you reduce the probability of going wrong a lot. Because what these emotions tend to do is to concentrate your efforts saying, I think I'm going to put more money into real estate. I'm going to put more money into gold. The world is coming to an end. I'm going to look at equity moving, or I'm going to put more of my money in crypto. Look at what's happening there. So forget about biases. Just as an action, just don't be concentrated.
Yeah, I think, which again brings us to the point, like you were saying, you have a process, you have a diversification in your portfolio.
Absolutely.
And I think one important point which you were trying to arrive, and let me help our viewers understand better, is that one should always have reasonable expectations of outcomes or results. Like you said, you cannot be expecting equities to give you abnormal returns. I think when you have reasonable expectations, you kind of take those decisions in a more balanced way.
It is.
Broadly.
It is. I think you hit.
I think one of the points which I would like to add is about cryptocurrency and assets. It's we know it's an asset class which just swung in one way,
Right.
having phenomenal returns, and people were just chasing that all the while. But when you have high volatility, inflation, and globally interest rates moving up, you know where Bitcoin today is. I think if I have the latest numbers, it's just maybe below $20,000
That's
per
right.
coin. So I think we needn't be swung by emotion and
It is.
Hysteria around. I think balance your emotions, have clear goals, do not have concentration, and have a process. I think that pretty much summarizes that piece.
I would agree completely.
Great. Which brings us to the next part of a question is that Indians have always been fascinated by the domestic stock markets, that's a fact, and hence have really not kept keen interest in markets outside to a large extent. What are a few points on international investing, and what is PGIM doing in that space?
Sure. I think it's an important question that you raise, Aditya, because if we are convinced about equity investing and we are convinced about buying good businesses that are growing, then we should be very commonsensically aware that that is all around the world, not just in India. What makes it even more important is that there are many sectors and stocks that are not available in the Indian stock market.
Right.
And just to give you an example of something like this, a sector which is reasonably large abroad, does not have too much of a negative impact related to recessions and things like that, is the sector of luxury. Right? And we may say that we may have a stock here or so, a jewelry brand or watch brand or whatever. But if you think about it globally, whether it's the Ferraris or the Louis Vuittons or the, and you're catering to a ultra high net worth segment who doesn't worry about recession at all. That sector's been doing well, and we don't have that sector. You think about cloud computing. And infrastructure companies, digital infrastructure companies not available in India. Health tech companies. So there may be one or two, but you don't get a wider variety. So your real reason for investing internationally should be that I am investing internationally because I'd like access to sectors and stocks which are growing. But are just not available in the Indian stock market for me to participate.
Absolutely.
That's the reason. We are a 3 trillion market capitalization. As India, the whole world is around 110 trillion plus. So we are such a small percentage. And if why not expose a 10% or a 5 or 10 or 15, whatever works for you, along with your advisor, to international strategies. I think that's the real reason to actually have it.
So I think a very important perspective again for viewers. I think it's very important, like you said. I think the decision to actually invest overseas could be driven predominantly by getting exposure to sectors overseas in international markets which may not be present in the domestic markets. That could be one way of having a portion of the portfolio invested overseas. And I think globally, I think if you look at back of the envelope, if I may just add my part of the experience, I think on an average, you can always have 10% of your portfolio invested overseas, to get a diversification, or let me say a geographical diversification to your portfolio.
In your asset allocation, yes.
So that's all of the piece. Obviously, like for viewers, it's very important to understand, in a scenario like we are in right now, just for our viewers, obviously, globally high inflation and interest rates, it's a very different kind of challenges that we're facing this year because of the Russia-Ukraine war. But I think the idea is to have access to markets outside. As long as that point of view is clear, one can go ahead with that decision.
Absolutely. And you get the secondary benefit of diversification in your asset allocation as exposure to currency.
Absolutely.
In a sense, as an Indian investor. So I think it has a couple of benefits.
Yes. Thank you so much. And very important subject, and which brings me to the next question. See, retirement is a subject you're very passionate about. And PGIM India had a couple of years ago released a retirement readiness survey report.
That's right.
Exclusively for the India market. Could you share some findings from that, which could be relevant for a viewer?
Sure. I think this has definitely been a subject of interest for me because we don't have really social security, so to speak, in India, whereas you see this abroad quite frequently, and therefore it's very important for every individual to think about it. All surveys, and I'm not just talking of our survey, talks about retirement as a financial goal being the 3rd, 4th, or 5th priority. And that's exactly what we found in our research as well. People don't tend to prioritize retirement as the first one. They'd like to work for their children or their spouse or their families and their other goals. And then retirement is okay. It'll be like your fifth or sixth one. So we did find that the people who were more ready for retirement, almost half, a little less than half the population that we had surveyed, the ones who said that they are more ready for retirement are ones who had a second source of income.
Okay.
Right? They've found themselves to be a little more ready for retirement from a confidence point of view. People who came from joint families found that they were better prepared for retirement. I think it's just the social support system. The bigger social support system that you're a part of, the financial anxiety is lesser. You feel somebody has your back.
Right.
But for more nuclear families, it has been difficult. They worry about their financial futures.
Right.
We found also that retirement as a word connotes negative impressions in the mind. It's about your old uncle who is taking the kids to school and back, has blood pressure and diabetes and is, all of that, and has not much purpose other than doing housework and things like that. And so I would say that for the benefit of our audiences, also not just with our research, but also with the science around this that is, that is important, is the biggest risk you run for a retirement when you're thinking about retirement is concentration. Again, right? Concentration of having done one job for maybe 30 or 35 years.
Right.
So the best way to tackle retirement is to have diversity in your life interests 5 or 6 years before retirement. Start having things that you can actually work on, commercialize, earn a little bit. It could be a hobby that you take forward. It could be something that you've always wanted to do, but start preparing for that. Because let me give you a simple example. If I tell you a statement, you can be rich and happy, and you can be rich and unhappy. Both the statements are true, right? If I tell you another statement that says you can be poor and unhappy, and you can be poor and happy.
Right.
Both those statements are true as well.
Right.
My point being, it's not the money. It's not the money. It is about how you will spend your time purposefully. Even if you fall a little short here or there on your corpus, if you spend your time purposefully and happily, you have everything going for you in retirement. The converse is where the challenge actually lies.
Great. I think very useful, very insightful data which you got from this. And just to summarize for the viewers, I think what we could quickly infer is that families in India which have any secondary level of support, if I were to make it more neutral, the secondary levels of support could come from joint family or having a second source of income, have a higher confidence index.
Absolutely.
That's, I think, the key takeaway here. And yes, I think it's insightful that maybe the way we look at the word retirement is kind of perceived a little negative, as we mentioned, but I think the essential element here which we're trying to say for audiences here is that retirement is all about how you're allocating your time in that part of life, in that part of the journey.
Absolutely.
Because the assumption is you've already made yourself financially secure, or you're already up the earning curve or ladder. But it's the time how you want to spend becomes essential. And you brought out a very important part is that 5 or 6 years before you actually want to hit the button of retirement, or where you want to
hang up your boots.
I think it's very important to kind of understand from an individual perspective what are the other individual hobbies, interests, or things, or which you want to pursue, which are over and above your corporate life, which you've been pursuing over the last 30, 40 years. So I think understanding those areas of interest is really critical, and that's the key point I want to drive here, because that will help you to manage your time and allocate to something which really interests you and keeps you occupied.
That's true.
And more importantly, keeps you happy.
And keeps you happy. And, I think the best way to understand this is that retirement is the only financial goal of your life for which you don't get a loan. You see, we all invest. We want our kids to be good, study at the best places in India or abroad. We want to buy a house. We want to buy a car. We want to start a business. Guess what? You can get a loan for all of that if you're falling short of your goal. The one thing that you don't get a loan for if you fall short of is your retirement corpus.
Absolutely.
That's one reason why you should be prioritizing that anyway. And things like reverse mortgage and stuff like that doesn't work too well in India.
True, true. Yeah, I know reverse mortgage is more of, in
Yeah.
US it doesn't work.
Yeah.
In India, that all of us are so much
True.
kind of connected to a residential
That's right.
home. There's an emotional connect.
That's
So
true.
We'll take that question some other time.
Yes.
Which brings us to our next question. In a world where active versus passive investment has been a debate, being an active asset manager, what are PGIM's views on the same? And I'd like to extend that question is that do you feel that India and the rest of the world still has a lot of juice left as far as active investment is concerned?
You know, my take on this, Aditya, is that there is nothing called passive investments in the way that people understand it. There is only active investment at low cost or at a higher cost.
I think
You
that's
see,
a very different perspective.
it is
to bring you on
because
board.
an index,
Yeah.
who do you think makes it? Like, if we think about an active fund, we think that there's a fund manager there.
Yeah.
Who makes an index? There's a committee who makes it, who decides that, okay, which stock's going to get in and which stock's going to get out.
Yeah.
Indexes are being recast all the time
Right.
based on certain parameters.
Yes.
If you go back in time, indexes have got it terribly wrong at the peak of cycles by bringing in companies into the index absolutely at the wrong time.
Yes, yes.
So at the end of the day, if there is a committee sitting somewhere deciding a formula by which stocks should get into an index, it is active according to me. The advantage is that it is at a lower cost.
Right.
And for active fund managers, many a time, that cost that they may charge a little extra because of running a whole firm and
Yeah.
paying people is something that on a compounding basis tends to detract from returns. Not to
Right.
say that there aren't active managers who do well.
Right.
It may be getting lesser and lesser, but they are out there. So I think the decision to really take for us is, and as PGIM, I don't think we would say no ever to adding strategies which could be on the passive side as we know it, which is index funds, which could end up becoming solution orientation, building blocks for solutions that you may want to make. But on your second part of that question about India and active funds, it could be a personal bias again. I would prefer an active manager.
Yeah.
And as I get older and older, when I think about my investments, when I start wanting to draw down on my investments, the cost of that investment is going to be important because now the compounding of my corpus and the small amount of withdrawal rates that I do should not be impacted by higher costs. So I'd go active in my young life, and I would probably move towards passives at the later stage of my portfolio and my time. That's how I see it.
So which brings us an important conclusion here is that, and if I were to kind of, mention the points again for the viewers, is that perhaps there's a notion that in the earlier, younger part of life, active fund management could perhaps be correlated with incrementally higher returns, and because an individual probably has a higher earning capacity, probably he would have a bias to go for that style of management, and somewhere the higher cost is being offset by the high returns an active fund manager is bringing on the table, is what I understood. But like you said, towards the retirement, the earning capacity may be at the peak, but then you would like to preserve your capital to a large extent.
Yes.
So you would want that a lower cost fund would probably be better because it will be little lesser returns, but then you are kind of preserving
Yes.
your capital. You're taking lesser risk as well, and I think it's a balancing act.
Yeah.
But broadly for viewers here, if I'm right, is it fair to assume that active fund management is more of a style of investing in developing economies, and developed markets are today more geared towards passive funds broadly?
I think you could say so, as evidences have mounted that active managers have not been able to beat their benchmarks, net of fee. That has been the trend that has obviously been in the Western world. But please remember that when you're investing in indexes, it's backward looking.
Yeah.
Right?
Absolutely.
Whereas in a developing economy like India, where you have multiple opportunities, multiple sectors in developing, good fund managers do have an opportunity to pick up stocks outside of the index, which can give you good growth. And therefore, you could be a little more biased in a country like India towards active. It's also dependent on the person. Like I said, for me, it's a personal bias of how I would look at it as two stages. For somebody else who has very low risk, Even as a young person, you could think of indexes. I think more important is to say that you should be thinking about your allocation to equity and ask questions around that. And then come to the question of what style do you like?
Sure. Well enough. And thank you for the inputs, which brings us to the last part of a question. And what is PGIM India's investment philosophy? Maybe if you can share.
Sure. We follow an investment philosophy called GARP.
Okay.
GARP, which stands for growth at reasonable price, which essentially means that we are growth investors. Right. We are chasing growth. We are looking for growth. But growth at reasonable price means we won't buy it at any price. And so we look at various parameters in the portfolio that we have to think about the valuation of those stocks we have in the portfolio, and have a process and a formula by which we will start reducing the allocation to a stock or eliminating it completely when it crosses certain thresholds. Okay. This is where I said that the behavioral biases are also controlled by having certain processes in place. That doesn't tie up the hands of the fund manager, but these are more guardrails so that you don't make the biggest mistake of all, which is overpaying for an asset. The moment you overpay for an asset, you have to be sure that it's only good news that's going to drive it from there on, and you can't predict that. True. So if I were to just touch upon, for paucity of time, one factor, for instance, that defines how we bring stocks into our universe. Right. We bring stocks into the universe only if they have had at least 7 years of consistent positive operating cash flow. 70% of their reported financials are 7 years out of 10. It's a pretty strict one, and there are stocks for that. There are enough stocks for that as well. Right. The reason we do that is, and I'm reminded of a quote that my fund managers use, top line is vanity, bottom line is sanity, but cash flow is reality. Yeah, that's it. And it can't be too frauded around, on the cash. So when we look at that, what it does is that, why 7 years? Because most business cycles are of 5 years, and if a company is positive on its cash flow at the bottom of a cycle, it's a resilient business and will gain much more share when the cycle turns. One of the evidence of this process that we are in investing, as I mentioned, is we did not invest in a single IPO in the last year. Right. So we did not lose money for our investors in that sense. We invested in 2 IPOs which were unconventional, and we made money on both. So I think, again, coming down, a full circle back to process, I think the GARP philosophy, with the underlying guardrails that we have put to make sure that the fund managers have a reasonable methodology by which they're approaching it, while leaving them the flexibility to manage the mandate, is how we approach it. And we continuously think about how to keep enhancing that as well.
Well, I think, thank you so much. And I think, I would like to use one key word, which is, what about, you mentioned about the philosophy, the GARP philosophy. And I think the word, which is like, post 5 years, and the company is in existence in the 7th year, you brought a very important word, and for viewers, that is resilience. I think resilience, and it's all the more important in the last 2 years since the pandemic. And I'm just taking a leeway to just spend a little, a few seconds on that. It's about how individually resilient we are, how resilient an economy would be, or a country. It's the driving force to keep us going.
That's right.
And give us a lot of courage in tough times to move ahead in life. So I think that's the key word here. And I would like to extend my vote of thanks to you for this insightful session.
Thank you, Aditya.
And on behalf of AKC Capital, we'll be back again next time with a new insight on the markets and another knowledge series. Thank you so much.
Thank you, everybody. Thank you, Aditya. Thank you for this opportunity.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.